Let's get to Bob Pisani. Bob?
Flattish week overall and really mixed results. Retailers up and down. Just take a look today. And again, somewhat inconclusive on the trading directions here. There's the semis up fractionally. Retail doing a little bit better. Banks a little bit better. Materials, industrials here. Overall, modest upsides. I think the important thing on retailers is a lot of them were, well, the expectations were pretty low. So it's nice to see Gap was moving on the upside at the open. Nordstrom was on the upside. But again, very low expectations. The good thing about Gap, you can put up the retailers here, essentially affirming the full year. Again, though, this is a sign of the low expectations there. And if you see, trust me, they're trading on the upside. I think the important thing here is if you take a look at what the retail winners are this year, it's really a small group, folks. It's one company, Target, and then it's the discounters. Costco, Ross, TJX, and Walmart. All discounters. These are your winners this year. And when you compare them to the group of losers that are out there, it's pretty stark. The important thing is the apparel makers and the department stores have market caps now that are essentially mid-cap. I'm being generous. You can argue that they're large, small-cap stocks. So if you take a look at some of the retail market caps that are out there, Gap is a $6 billion market cap. Why does that matter? How about Target? $64 billion market cap for Target. Gap $6 billion, a tenth of the size. Hanes Brands is $5 billion there. Nordstrom 5, Macy's 4. Hanes Brands, an underwear company, has a bigger market cap than Nordstrom and Macy's. You see what's going on here? These are essentially becoming very, very modest impact on the overall markets because they've been down relentlessly, 30, 40%, some of these stocks throughout the year. Very, very difficult for them. Finally, I just want to comment on the Wall Street Journal article on Bridgewater taking out what looks like very large put positions. There's a little less here than meets the eye, I think. It's very cheap right now to buy protection. So here's your VIX right now at 12. Here's some of the futures contracts in December, in January, in February, and March. And you see, while they go up, they only go up modestly, 15, 16, 17. This is hardly apocalyptic here, even going out into March. So what does this mean? Well, number one, if you're buying 1% of your firm's assets to buy protection this cheap, that doesn't seem like a crazy idea. That seems like a very rational thing. It's cheap to buy protection right now. Puts are about as are higher, and the VIX is about as low as it's going to get right now. You don't need to go in the money to be profitable. This is very tied to volatility. Volatility goes up, the value of those puts go up as well. So I don't think this is some kind of apocalyptic bet. I think it's a mathematical calculation that probably makes some sense.